Assalamualaikum. Hi everyone. I'm Nurul Farahim binti Abdul Rahim. I and my friend will going to present to you about financial ratio. Okay, financial ratios are created with the use of numerical value of taken from financial statements to gain meaningful information about a company. The number found on a company financial statement, which is balance sheet, income statement, and cash flow statement, are used to perform quantitative analysis and assess a company liquidity, leverage, growth, margin, profitability, rates of return, valuation, and more. Okay, financial ratios are grouped into 5 categories, which is liquidity ratios, is how liquid the firm to meet short-term obligation. Leverage ratios, how the firm finance its assets to determine the capital structure. And then activity ratios, to measure efficiency of assets to generate sale. Profitability ratios, to measure the efficiency of firms to generate profits. And the last one is market value ratios, to concern the shareholders. As for my part, I will explain to you about liquidity ratios. Liquidity ratios are financial ratios that measure a company's ability to repay short and long-term obligation. Common liquidity ratio include the current ratios, quick ratios, and network capital ratio. Current ratio is to measure a company's ability to pay off short-term obligation. The quick ratio is to measure company ability to pay off short-term liabilities with quick asset. And the last one, the net working capital ratio, measure a company to ability to pay off short-term liabilities with net working capital asset. Okay, based on the Snapcrackers Indan Berhad for year 2018 and 2019, we need to find the comparison between 2019 and 2018, and also 2019 with the industry average. Okay, I'm going to find for current ratio and quick ratio. So, for the current ratio, for the year 2018, the formula is current asset divided by current liability. So, the total current asset, which is cash, marketable securities, account receivable, prepayment, and inventory, divided by total current liabilities, which is account payable, not payable, accrual, and tax payable. Okay, so the total will get 2.23 times. So for the 2019, the total current asset is also same with the 2018, but different total, and divide by current liabilities, which is we got 1.90 times. So the comparison between 2019 and 2018 are poor, because year 2019 is reduced from 2.23 times to 1.90 times. For the year 2019, the current ratio also poor compared to industry average, from 4 times to 1.90 times. Okay, next one is quick ratio. The formula is current asset minus prepaid expenses minus inventories divided by current liabilities. For the 2018, as now we got the total current asset, which is 155,950 minus with prepaid expenses 40750 and minus with inventory 30,000 divided by 70,000, which is total of current liabilities. We got 1.217 times. Okay, so for 2019, the total of the current asset 152,200 minus with prepaid expenses which is 15,000 and minus with inventories 25,000 and divide by total current liabilities 80,000 will got 1.403 times. So during 2018 to 2019 are good because it was increased from 1.217 times to 1.403 times. But compared to industry average, the quick ratio for 2019 also poor because it was decreased from 4 times to 1.403 times. So for the overall performance between 2018 and 2019 for the current ratio, the firm is unable to make its short-term obligation and worse than the year 2008 as it has lower value of ratio. But for the quick ratio, it's able to make short-term obligation and better than the year 2018. For 2019 and industry average, both ratios show the firms are worse than the industry average, indicates the firm unable to meet its short-term obligation.
Muhammad Khalid. My part is leverage ratios. Leverage ratios are to determine the capital structure and how the company finance their assets. So I would like to present leverage ratio for snacks, crackers, Sdn Bhd. Firstly, comparison between the year 2018 and 2019. Total liabilities divide total asset equal to debt ratio. For 2018, total liabilities 70,000 plus 7,500 plus 8,450 plus 14,000 plus 55,000 divide total asset which is 206,950 equals to 74.87%. Then for 2019, total liabilities 80,000 plus 66,000 plus 7,000 plus 10,250 plus 15,000 divide 189,500 equals to 62.72%. For time interest earned, earning before interest tax divide by interest. For 2018, 21,600 divide 3,600 equals to 6 times. For 2019, 58,900 divide 5,600 equal to 10.52 times. So, on 2019, debt ratio on 2019 are better than the year 2018. That shows the company is good in managing their debt and face low financial risk. Besides, the company could not meet its interest payment obligations. Secondly, comparison between the year 2019 and industry average. For debt ratio, industry average given is 33%, while for 2019 is 62.72%. For time interest earned, industry average is 7 times, while 2019 is 10.52 times. So, debt ratio for the year 2019 is poor. That shows the company has higher debt compared to the industry, and this indicate that the company is in a risky positions. However, the company's ability to pay the interest on loan requirement is more better compared to the industry. Thank you.
Assalamualaikum. Hi everyone. My name is Muhammad Rafi bin Abdul Hamid. I'm going to explain to you about activity ratio. Okay. Activity ratio is a type of financial metric that indicate how efficiently a company is leveraging the asset on the balance sheet to generate revenue and cash. Activity ratios are useful for comparing how a company performance is trending over time in a horizontal statement analysis, or how company performance fares against its peers in comparable company analysis. They are also known as turnover ratio or operating efficiency ratios. Okay, activity ratios have a 5 formula, which is the first one is inventory turnover. Is cost of goods sold divided by inventories. The second one is average collection turnover. Is account receivable divided by annual sales times 360. The third one, account receivable turnover, is a sales divided by account receivable. The fourth one, fixed asset turnover, is a sale divided by next fixed assets. And the last one, total asset turnover, is a sales divided by total assets. Okay, so now based on question from Snack Crackers and Numberhead, we need to find comparison ratios between 2019 and 2018, and between 2019 and industry average. First one, we need to find average collection period for year 2018. The formula is account receivable divided by sales times 360. Okay, 49,200 divide 350,000 times 360 equal to 50.61 days for year 2019. Okay, for year 2019, 55,000 divided by 450,000 times 360 equal to 44 days. So, the average collection period for year 2019 good compared to year 2018. For the year 2019 also good compared to industry average. For year 2019 is 44 days below the industry average, which 90 days. Okay, then fixed asset turnover for the year 2018, the formula is sales divided by fixed asset. 350,000 divide 20,500 equal to 12.28 times. For the year 2019, 450,000 divide 37,300 equal to 12.06 times. The fixed asset turnover for the year 2018 are poor compared to 2018. for the year 2019 compared to industry average are good, which is for the year 2019 12 times and industry average is 10 times. Last one, inventory turnover for the year 2018, cost of goods sold divided by inventories, 250,000 divide 40,750 equal to 6.13 times. And for the year 2019, 284,000 divide 15,000 equal to 18.95 times. The inventory turnover for the year 2019 are good. Then for the year 2019 compared to industry average also good. In the year 2019 is higher. Is higher than industry average, which is 2019 is 18.9 times and industry average is 15 times. So far, the interpretation comparison between year 2019 and 2018 for average collection period and inventory turnover, there has better performance in utilizing their asset compared to year 2018. But for fixed asset, turnover was to compare with 2019. It shows that the company is not efficient to utilizing their fixed assets to generate sales. Comparison between 2019 and industry average, the firm has better performance in utilizing their asset compared to industry. They are utilizing their asset efficiently and effectively. So, that's all from me. Thank you. Hope you all stay safe and stay at home. Assalamualaikum.
My name is Nik Aida Farhana binti Syahadan. So I'm going to explain to you all about profitability ratio. Profitability ratio measure all the combined effect of liquidity, asset management, and debt management and overall operating result of the firm. It relates to the firm ability to satisfy the firm goal to maximize the wealth and to attract new capital and to grow over time. Okay, 5 formula under this ratio. First is gross profit ratio. Okay, gross profit ratio is gross profit over sales. Second, we have operating profit margin. So, operating profit margin is operating profit EBIT divided by sales. Number 3 is net profit margin. So, earning after tax divided by sales. Return on asset. Return on asset is earning after tax divided by total asset. Return on equity is earning after tax divided by total equity. Based on the question, we need to do comparison between year 2018 and year 2019 and comparison between year 2019 and average industry. First of all, we need to find the net profit margin for year 2018. The formula is earning after tax divided by sale. So it will be 9,000 divided 350,000. We will get 0.025. The answer must be in percent. So it will be 2.57%. For year 2019, okay, 26,650 divided by 450,000. Okay, the answer is 0.0592. Okay, the answer must be in percent. It will get 5.92%. Net profit margin for the year 2019 is good compared to year 2018. For return on asset, the formula is earning after tax divided by total asset. Calculation for the year 2018, 9,000 divided 206,950. Okay, and the answer is 4.35%. For year 2019, 26,650 divided by 189,500, and the answer is 14.06%. Return on asset for year 2019 is good compared to 2018. For return on equity, the formula is earning after tax divided by total equity. Calculation for year 2018, 9,000 divided by 52,000. The answer is 70.31%. For 2019, 9,000 divided by 70,650. So the answer is 37.72%. Return on equity for year 2019 is good compared to 2018. Comparison between year 2019 and average industry. For net profit margin, average industry is 4.0%, while for year 2019 is 5.2%. Return on assets for average industry is 20.0%, while for year 2019 is 14.6%. Return on equity, average industry is 12%, while for year 2019 is 37.72%. The firm show net profit margin and return on equity are better than average industry, but return on asset is worse. It shows the company not able to maximize the shareholder wealth.
The company will be able to borrow more money in the future. So the answer is yes. If the company able improve their liquidity ratio, especially for current ratio, liquidity ratio indicate the ability of companies to convert asset into cash. In terms of credit analysis, the ratios show the borrower's ability to pay off current debt. Higher liquid ratio suggests a company is more liquid and can therefore more easily pay off outstanding debt. So the current ratio is a liquidity ratio that measures the ability to pay for expenses for expressing the number of times asset exceed the liabilities. So that's all from us. Thank you.